right, it's 7:30. Welcome everybody to the webinar today on building a winning portfolio of stocks. As part of the celebration of the Financial Literacy Month of 2021, AIB-AXYS Africa and Abojani Investments have collaborated to bring you this webinar, and we are so excited to have you here tonight. Allow me to switch off my video as I introduce the companies and both the panelists. AIB-AXYS Africa Limited is the fusion of two established companies, AIB Capital Limited and Apex Africa Capital Limited, both with over 25 years of experience in the securities market. AIB-AXYS forms part of AXYS Group, which is based in Mauritius, with subsidiaries in Switzerland, UAE, and Hong Kong. AIB-AXYS Africa's key services are stockbroking, bond trading, derivatives and securities lending and borrowing, and corporate finance. AIB-AXYS also provides online stock trading capabilities through the established brand AIB DigiTrader, the first fully automated trading platform in Kenya. Clients open CDSC accounts either through the app or online platform, trade and make payments, including through M-Pesa, from the comfort of their homes. Abojani is a financial literacy organization. Financial literacy is the understanding of personal and corporate finance matters such as investing, saving, budgeting, compound interest, the stock market, and portfolio diversification. Abojani Investment helps professionals and entrepreneurs get the right financial education and build fully diversified investment portfolios to help them accomplish their financial life goals. In today's webinar, you will have the opportunity to listen to two great industry leaders. I would like to introduce our moderator today, an industry leader with passion for ensuring that investment analysts and by extension, investors get the right education and professional services, Diana Morioki. Diana is the CEO of the Institute of Certified Investment and Financial Analysts, ICFA. She has over 12 years experience in the financial services industry. She most recently served as a senior manager, investments at Actuarial Services Limited. She also served as investment officer and head of member services at Arima Fund Limited. She's a full member of ICFA and also a member of the Chartered Institute of Securities and Investments, UK. She holds a Master of Science in Finance and a Bachelor's in Economics and Statistics. She is a recipient of the Top 40 Under 40 Women Award in the year 2019 by the Business Daily Africa, which is an award that recognizes the most influential and progressive women in corporate Kenya. She was also commended by the ICFA Council at the first Fellowship and Commendation Award ceremony held in January of this year for outstanding contribution to the growth of ICFA and the profession. Thank you, Diana. I would also like to introduce our speaker for the day, who is also an industry leader with a passion to enhance the quality of people's lives by providing them with first-class tailored financial solutions, Paul Mwai. Paul is the CEO of AIB-AXYS Africa and has over 20 years experience in the financial services industry, including fund management and investment banking. He has worked in various departments within the Barclays Group, including Barclays Merchant Finance and the Barclays Dealing Center, before joining the Barclays Trust Investment Group as a fund manager. He then moved to Old Mutual Asset Managers as a senior portfolio manager and asset allocation strategist. Paul joined AIB Capital in February 2012 from African Alliance Investment Bank, where he was the chief executive of the asset management company. He is the current chairman of the Kenyan Association of Stockbrokers and Investment Banks and sits on the board of the Nairobi Securities Exchange. Paul holds an MBA from Strathmore Business School, Bachelor of Business, University of Southern Queensland, and an investment management certificate from UK Society for Investment Professionals. He is also an associate member of the Chartered Institute of Bankers and an authorized representative for the Growth Enterprise Market segment, commonly known as the GEMS. And Paul is also a member of ICIFA, the Institute of Certified Investment and Financial Analysts. Thank you, Paul. I'll now hand over to our moderator for the day, Diana.
Wow, thank you very much, Nailante, for that great introduction. I'm sure Paul and I were wondering whether those are our profiles, but thank you for stating them so well. We truly appreciate, and thank you for handing over. As Nailante has mentioned, I'm FA Diana Morioki Maina, the CEO of the Institute of Certified Investment and Financial Analysts. And kindly allow me, Paul, I'm sorry for stealing your platform, but can I please introduce ICIFA for the sake of our guests who are joining us?
Please do, please do.
Okay, thank you for the go ahead. So I just gave a brief introduction about ICIFA, and since I'm seeing a couple of attendees I've seen one from Atlanta. It's good to see you from around the world. We recognize you this evening. Here in Kenya, it's actually evening. I don't know the timeline there in Atlanta, but it's good to see you. But just to mention that ICIFA is the professional body established under the Investment and Financial Analyst Act of Kenya, which was enacted in December 2015. And ICIFA's mandate is mainly to regulate the investment and financial analysis profession and to register and grant practicing certificates to certified investment and financial analysts. So therefore, persons offering investment and financial advice required to be registered members of ICIFA, and firms as well that offer investment and financial advisory services required to have at least one practicing member of ICIFA as part of the firm. And just to confirm that AIB-AXYS and Abojani are both registered firms by ICIFA, since they have ICIFA members as part of their staff in the respective firms. And also confirming, as you have heard, that Paul Mwai is a practicing member of ICIFA. When you hear me say FA, it's just the designatory letters to recognize that a member is a member of ICIFA. So FA is just short for financial analysts. So that's it, FA Paul. I just wanted to set the stage and just recognizing that you're actually duly recognized by law to offer investment and financial advisory services.
Thank you, Diana.
Okay, great. So with that brief introduction of ICIFA, it's great that we have a financial literacy month because I've seen from a couple of platforms, online, international platforms, people asking, what is the one thing you wish you learned when you were in school? And it was very clear that majority said they wish they learned financial literacy in school. And given that people are now recognizing it, especially at these challenging times, that financial literacy is important, and majority also realizing that it's very important to make wise investment decisions, because you don't know the time that those investments will come through, especially when there are emergencies to be attended to. So based on that, FA Paul, in your opinion, why is financial literacy important? And what are some tips that you want to share with our viewers today on how to better manage their personal finances?
Thank you, Diana, and welcome to everybody who's joining us this evening. It is indeed an honor and a privilege to be part of this venture. Allow me first to perhaps recognize the good work that Abojani has been doing in terms of financial literacy. We have partnered with them in the past, and I know that this is definitely something that's very close to their heart and that they're very passionate about. And we really are always glad to have this opportunity to support them in the quest to get financial literacy. So going to your question, Diana, yes, why is financial literacy important? I think, you know, everybody makes money or through the course of their lives. And it is important, and sooner or later you will need to come to invest. And an investment is what really makes the big difference between what you live and how you live. It's important because it's able to allow you achieve your objectives. The key about financial literacy. So we normally say that financial literacy is a life skill, and you need at least even if you are to depend on someone to advise you, you need a certain level of financial knowledge to be able to appreciate what advice that that you'll be able to get. So it's very important to understand that. And through my 30 years of working and being in the financial sector, I have seen so many people almost reduced to poverty because of simple mistakes that they could have learned or that they could have taken out, understanding when to take risks and when not to take risks, understanding how risk evolves over time, understand the nature of investments. And I think, we have a lot of cases of people who have gone into investments with very high expectations and being disappointed. Just a little of financial education and a little financial literacy would go a long way in reducing those kind of situations. I've seen people lose almost their entire wealth because of very simple mistakes that could be resolved from financial literacy. So sooner or later, everybody will have to come across an opportunity to invest in one form or the other. And it is important that you have at least a basic level of understanding to be able to achieve that. Thank you.
Okay, thanks, Efe Paul. You've mentioned 30 years in the financial sector. Maybe if you could go back in time to say when you were in your 20s, not that I want to assume your age or anything or giving off your age, how would you advise your younger self in terms of how to better manage your personal finances? Or what would you have wanted to learn better in terms of investing?
Okay, thank you. Okay, the first thing that I'd have liked to learn better is always the issue of save fast. So, pay yourself first. I think when you're young, your priorities are different. You're looking to settle down. You want to buy a car. You want to buy furniture for your house. And those become the priorities because maybe you've just started a job and you've just rented a house. It doesn't have one or two items. It doesn't, and those with time you find yourself going there. The other thing that a lot of people do when they are young is they take loans. So people join the SACCO and they take loans. The advice I would have given myself if I was younger is to start with savings. The minute you begin to earn a salary, the first thing really you should do is to put away some form of saving scheme or the other, whether it's a SACCO, whether it's just a unit trust, whether it's just a regular investment, and to always do that. The second lesson that perhaps I would tell myself is to learn patience in terms of investment, because what happens is that when you're young, you really want to make money quickly, and when you're investing, you tend to have a bit of a short-term focus. In effect, that's when you have the most time to invest, and maybe what would be wise at that time is to have the patience that when you invest, give it the time to mature and to make the difference, so that you're able to grow. So here's the key thing is start saving early, start investing early, and do it regularly from a young age. You'll be surprised what kind of difference that would have done. even 5 years of additional investing time could be the difference could almost mean doubling your wealth, depending on what time you start or don't start.
Okay, great tips there, Paul. Maybe I can summarize them for the sake of our viewers. He's talked about 3 key points. Number 1, start saving early. Be patient, have a long-term view. That's 2. And 3, invest regularly. So those are great tips by F.A. Paul, and I believe you will you have noted them down in summary. And I remember when you started, Paul, you talked about people, as part of financial literacy, people need to be more aware of risk. They need to be aware of returns. And there's a seventh wonder of the world, which is called compound interest. Maybe if you could try and simplify this as part of financial literacy, how one is required to have just the basic knowledge about risk, return, compound interest, and any other money skills that will help someone when invest, because now we have encouraged them to invest regularly.
So the risk and return is a trade-off. So the higher risk you take, the likelihood of better return, and the lower risk you take, the likelihood of lower return. And risk is really always a question of probability. So if you look at certain investments, some are high risk. So then we say, for example, the stock market represents a high risk investment, but should ideally give you a higher long term. If you invest in treasury bills, you get lower risk. Lower returns, but you're more certain of your investment. So what the key thing about risk and return is that ideally, when you're younger, they encourage you to take higher risk because you have the time to allow that risk to play through, because the risk is just volatility. So you would have a stock market where the market has gone down and has stayed down for 3 years. If you are just about to retire, then you may not have the advantage of that patience. The other thing is what they say is compounding, and over time, the wealth grows through compounding. I think they talk about the rule of 72. They say that if you take 72 divided by the rate of return that you're getting on your investment, tells you how many years it will take you to double your money. So if your rate of return is say 12%, it'll be about 5 years. You'll be doubling your money every 5 years. So that perhaps gives you an idea of how well compounding will be. And you can see that if you started with even $1 million shillings and you compounded it every 5 years, because the second compounding, you're compounding double already. So that effect really enables your wealth to grow faster. And sometimes we try and compare ourselves with people who are older. I realized that the reason why they are wealthier is because they've had the advantage of investing longer. It's not necessarily because they are better investors. And I'm not saying they are not better investors, but that is a critical thing so don't try and be like somebody who has been investing for 20 years longer than you, because that advantage of compounding, or the trade-off between risk and return that you might take, you might decide to take greater risk to catch up with that person, which results in situations where you almost wipe off all you have. The other thing that perhaps I'd like to add is when you get distracted and you take an investment that doesn't work, that pulls out from that compounding effect, and you lose many years of compounding. So say, for example, you had been compounding and then you decided, well, now I'm going to go and take a little risk. I'm going to invest in something more adventurous, like open a business with the money that you're saving. If you lose that money, the loss of that compounding effect is a great loss. And that's why they say that over time, you should reduce your risk so that you take the risks early. And as you go through time, then you have an opportunity to, to consolidate on the effect of compounding, so that your wealth grows in line with your expectation.
Okay, great. As they say in Swahili, haba na haba hujaza kibaba. So yeah, and that's the compounding applies to the second tip you talked about, long-term view and regularly. That's part of compounding really. And now that you've also advised about regular investing, I believe that most people, maybe people who are in other professions, say doctors, lawyers, pilots, entrepreneurs, they might think they're too busy to invest. Well, what in your opinion would you advise these particular people who feel they're too busy to invest? Maybe they feel that it requires a lot of number crunching. And what are some of the investment instruments that you recommend in terms of best allocation in terms of investing? What investment instruments would you recommend to these particular people who feel that they are too busy?
You know, I always give the example of investing is a bit like cooking, although I'm not a very good cook as such. If you're cooking and you want to stand over the pot until it cooks, and you keep opening the lid over and over again, then you will find that perhaps your food is taking too long to cook. Ideally, if the investment way that you're doing is you've got your recipe and you've put your dish in the oven and you've closed it up or you put the lid on it, and you know that it's going to take 1 hour, you then free yourself to go and do other things. Investment is similar. You need to understand the time frame that investment will take to mature, and give it the time it needs to mature, and not keep looking at it day in, day out. What I would probably recommend for most people, it doesn't really take a lot of time. You just need maybe to allocate an hour and perhaps diarize 1 hour every 2 weeks to say, I'm going to be reviewing my investment portfolio. Also, what a lot of other people do is that, they leave it to their investment professional to look at their investment. And then they come back a long time later without perhaps having interrogated that, and then they perhaps haven't met their expectations. So allocating maybe an hour every 2 weeks or every month, because investment is long term and you need to be patient, just to review and to say, am I on track? Am I achieving my objective? What's the kind of return that I had expected, and why am I not receiving it? That would be very beneficial. In terms of what investment you really can't do if you are a professional is to start another business, because that's also an investment, because then that becomes quite time consuming. But the whole idea about investing in stock market is to say that if I can't invest in a business, I can invest in a business that I'm running myself. I can invest in a business that somebody else is running, and that I have identified that they are competent people who are able to manage that business. Therefore, that's why we look at investing in the stock market. And we ideally recommend that you don't spread yourself too thin, because if you're going to follow the stocks, you need to have some stocks that you can follow and look at on a regular basis, rather than having 20 stocks which you will not be able to monitor and look at. The recommended number for an individual investor would be probably, in my opinion, and I don't think, is about 5 or 6 stocks, which gives you a right level of diversification. Then you're able then to monitor and keep track of your investments. You can also use other instruments such as collective investment schemes, unit trusts, which also you can buy bonds and treasury bills, which also give you different levels of return. You can buy property. All these kind of things allow for sufficient involvement from yourself that they don't necessarily tie you up from your regular professional work. But I think an hour every 2 weeks would be sufficient for everyone to look at their investments.
Okay, great insights there, Efe Paul. And now that you've said you recommend a portfolio of up to 5 to 6 stocks, that is a stock portfolio of 5 to 6 stocks, and mentioning that one can manage the portfolio by looking at that portfolio 1 hour every 2 weeks, then it seems that one can actually manage on an individual basis, given the tips that you have just mentioned. And before now they come to the portfolio, maybe you can take us step by step about the process of investing at the NSE. What will it take to start with the one stock in your portfolio? How do you go to build to get up to the ideal maximum? And you've already mentioned that you can monitor one every 2 weeks. Are there any, what are the specific platforms that one can keep track of the stock prices, for example, or even getting information around the stocks?
So obviously the first step in terms, once you have decided that stocks are part, one of the things I would say, if you decide that stocks are part of what I want to be investing in, it's good that you understand you're in there for the long haul. You know, this people tend to go into the stock market, then they're going to land, then they get out, then they're going into whatever. So one of the things they say is that, you know, the return that you will find from the stock market could be achieved in only 9 months. And if you miss out on those 9 months of, say, a bull market, the advantage of investing in the stock market could be lost by missing out in those. So what you really need to do is understand that, yes, I'm committed to the stock market. I'm going to be there over the long haul, and I'm going to continue investing on a regular basis. So once you open your account and you have an active account, you funded it, you then look for the 5 stocks that you look for. A good place to start would be to first of all do some level of relative analysis, and without getting too technical, but also look for the research reports and the recommendations of the various brokerage houses. Have a comparison in terms of what the research are saying. Look for companies that have strong management teams that you can be able to depend on to do a good job, and then look to commit that money into the stock market. Again, as you said, you know, you can start slowly. I would recommend that you start diversifying immediately, rather than maybe perhaps buy one stock and then sell. Now, once you've done that, the next thing that you then need to do, and I know this is much easier said than done, is to look to take advantage of opportunities when perhaps the stock market is high now and where the relative valuations are low, to build up your portfolio. So you buy when the market is low. Look for opportunities to sell into strength in the market. When you see the share price has been rallying and has been going up and has been going, that actually ideally represents the opportunities when you should be selling. Unfortunately, a lot of people think counterintuitive to that. When it is going up, everybody wants to buy. The other day, everybody was telling me, you got to buy Bitcoin, because it's going up. You need to buy it when it's low and sell it when sell it into strength in the market. But also, as you invest, then the other thing is that you need then to take account of, and most research reports will give you some indication of what the true value of that stock should be. So if you take that AIB research report on Safaricom, will tell you that according to their analysis, the value of Safaricom should be 35 shillings. Now, if Safaricom goes significantly beyond that level, then that's when you need to begin to go to sell. Or if it goes significantly below that level, then you need to begin to think to buy. So you need to have that kind of a benchmark, and you can get that either from one research report or you can even get the consensus of various research reports, and then therefore be able to say that, you know, my equilibrium level of Safaricom is 36, and I'll sell maybe 20% above, and I'll buy 20% below. That way you are able to monitor and manage your portfolio much more effectively. Be patient. The stock market has cycles. It goes up and down, and your patience will be tested. And I have been here 30 years, and I've seen times when we thought this stock market is dead, it'll never come up again. And normally they say the darkest hour is just before dawn. And sometimes when everybody is about to lose hope and looking to sell, that's when the stock market turns. So please be patient. Let's look long term. Let's look to capitalize on the opportunities that are there.
Okay, thanks, Paul, again for the great tips. Now, since you've mentioned a bit on monitoring, how to monitor your portfolio of the stocks, do you think a stop loss policy can apply in a portfolio? Because yes, we've talked about a long-term view. Do you think a stop loss policy would apply just to be cautious when a stock really plummets, just to make sure that the capital is preserved? What is your opinion about a stop loss policy?
Thank you. I personally would not recommend a stop loss policy. I think what it will end up making sure is that you are always making a loss, because you will find that it will go down and whatever. What you really need to do is to understand the fundamentals as to why the price is falling or rising. And if the price is falling, but the fundamentals of the company remain strong, then you need to have the patience to hang on. And that's why they say stock market is a long-term investment. It's a place for long-term investment. So you need to be able to ride the cycle of the decline if it is a mispricing that the market is mispricing. Rather, because you could be selling because of a market mispricing, saying it's a stop loss. And ideally, if you have a stop loss, you will be, from my experience, a lot of the times you'll be getting it wrong. You'll be buying, the stop loss will force you to sell at a loss. You buy again, the stop loss will force you to sell at a loss. The key thing is to stick to the fundamentals, monitor the fundamentals. However, if the fundamentals become weak, then you need to begin to think about selling. So that would be my recommendation.
Okay, great. I'm just thinking of it in terms of just locking in profits in the event. Yes, you mentioned that when you apply a stop loss policy, you could be stopping it at a loss. But what if it's just to lock in profits of, say, during a bear market, when stocks are really going down, like, for example, case in point, KQ, what happened with KQ. If a stop loss policy can be applied to the same, if you find the fundamentals are good, and then once you for example, you exit, you can re-enter the low price and expect that you will re-enter the low price, and in future the stock will go up. So in that instance, what's your opinion? Because I was just thinking about KQ, what happened. Someone might have thought, oh, fundamentals look good, and then we are in the current situation where it's currently not even trading.
Okay, I think it depends. It depends whether sometimes company would go through a temporary, or what you would refer to as a temporary slump. And KQ has been there many times before. Being an airline, because you use that example, it could be affected by a rise sharp in oil prices, volcanoes in Iceland, which have spewed ash into the air, and aircrafts can't fly. Ebola in West Africa. So those kind of things you need to be able to ride through. But when the company becomes fundamentally weak, like KQ became, because its financial parameters in terms of its debt levels becomes too weak. And particularly debt is one of the whatever, and it becomes unclear in terms of how to get out. Then you really need to, in my opinion, stay away from weak companies and concentrate on companies that have strong fundamentals. So it's not really about stop loss, because you see, in the case of KQ, if every time there was a volcano in Iceland, which spewed ash and aircrafts could fly, your stop loss was affected, you would be selling, but then the recovery would be maybe 3 or 4 months later, the share price would begin to go up. So that's why I'm not necessarily for stop loss. In fact, I look at it the other way. I say, if a company has strong fundamentals and there is nothing that's affected and the price is going down, rather than a stop loss, that's the opportunity to buy. Yeah. If the company is going up, if the price is going up and the price is unsupported by fundamentals, then that's an opportunity to sell. So I'm not sure if I've answered your question, but perhaps that's the way I would look at it.
Yeah, you have, and it has also brought out something which is important for our viewers, I believe. You've brought out the issue of debt as being a sign of weakness of a company. So how would you advise viewers when they're looking at maybe financial statements in terms of how to clearly see a trend in debt levels are becoming red flags when it comes to fundamentals? What are some of the things to look out for? Is it in terms of the debt to equity ratio? Well, we are not talking about, sorry, I was going along investment professional, but now we are talking about someone too normal, just wants to look, how can someone tell the signs of weakness when it comes to fundamentals?
I think the key thing is, yes, how much debt does this company have? Ideally, you'd prefer a company with some level of debt, because debt is also a risk factor. If the company is borrowing at a low rate, but the rate of the return in the company is above the cost of debt, then they are actually creating value. Sorry, I think I'm getting a bit technical. But the key thing is to look for companies that have some level of debt, but not too much. And so if the balance sheet is, if the company is 20% funded by debt, 30% funded by debt, that you'd say would be a good level of debt. If the company is all debt, then you need to be worried. And I think, if we take the example of some of the supermarkets that we've seen, one of the things that people forgot about supermarkets is that, first of all, they owe their suppliers. All the things that they are selling in that supermarket belong to the suppliers. The shelves are leased. The premises is rented, and on top of that, the company goes and borrows from the bank. And I remember the liquidator of Nakumat coming on the TV and saying, really, there was nothing, everything belonged to somebody else. So it's important that you understand what's the level of debt and what's the benchmark in that particular industry, because different industries, and compare with what others are in different industries. Yeah, so yes, debt is a factor to keep an eye on, particularly if a company has high debt and their profits begin to drop, then you need to begin to think to get out very quickly, or even begins to go into loss. It just means that company represents a higher risk level, and therefore you really need to keep a closer eye on profitability. If it begins to drop, then you need to think to get out as quickly as you can.
Okay, so Paula, any other signs of weakness you would advise when it comes to red flags on a fundamentals going weak, apart from that are common one and you can look out for without going to an investment professional?
The profitability of a company is one of the key pointers, because that's when you begin to know that the weaknesses, that's where they start from. You also need to look at how much the shareholders have committed in that company in terms of the funds that the money the shareholders have. Do they have sufficient reserves to ride off what you would call difficult times, like, for example, we are going in now? So that also then brings you to your debt equity ratio in one form or the other. I think you need to look for companies with stable money. So sometimes there are other softer issues that you need to look at. Very high turnover at the top of an organization is sometimes a pointer to problems within the organization. So I'm not saying that it necessarily means that, but perhaps it's a signal that you perhaps need to take a closer eye, a keener eye, and look at what exactly is going on in that organization.
So it means event management plays a key role as
absolutely. I mean,
identifying a stock.
Management is a key element. You need to be able to understand whether they have the right management skill. Do they have the right corporate governance structures? Who's on the board? That's to me, that is probably the number one factor that I would look at, and where I have any uncertainty about the competence and governance of management, I would ideally avoid investing in that stock.
Okay, great insights, Paul. And finally, for our panel discussion, we've seen a rebound of the stock market in the first quarter of this year. What in your opinion, is the NSE outlook, the future outlook? And just to mention, there's a famous quote by Warren Buffett that says, predictions often tell you more about the forecaster than they do about the future. But you can you can just give the outlook.
Okay, thank you. All right. Well, the one thing that we have learned in the last 1 year is that is very uncertain world. I mean, when we started 2020, we thought we would be, most of the problems were behind us. Interest rate caps had been lifted, banking stocks were going up, and we all had a very optimistic outlook for the year. And then COVID hit, and suddenly everything turned. Equally this year, as we started the year, we were we thought that perhaps the worst part of the COVID epidemic was behind us. We now find ourselves that perhaps it will not be out as quickly as possible. And the reason why I started that, they say that the farther back you look, the farther forward you can focus. So maybe that going on to what I can look forward to is, I think 2021 is still going to be a difficult year. It's in terms of particularly the first quarter, because we have the COVID situation still persisting. But it presents a very good opportunity for those to buy with long-term outlook. I think you need to look at opportunities to buy low in 2021. I expect the recovery in the stock market to come towards the second quarter, the second quarter of 2021, because the stock market tends to be a leading indicator and tends to move ahead of all other indicators, and perhaps into 2022, we should begin to see the stock market continue to gain. Obviously, we've taken a serious beating over the last 5 years. Many issues on the stock market have kept it depressed, have kept it from perhaps showing the kind of return that it has. But this has happened before. In the 90s, we were in a similar situation. And then in 2002, 2003, the stock market was booming, doing 102% in 1 year, I remember. And I think those kind of returns are still possible, and they are still there, a possibility in the stock market. I think that, you know, the depressed market has lasted quite long, and in my view should be beginning to come towards an end. And therefore, I would say that going into 2022, we should begin to see a recovery in the stock market. I think that's what I would say.
Okay, great. As per the stock market forecast by our forecaster of the day, FA Paul, it is a good time to buy in the stock market. Thanks for that, FA Paul. So we'll go straight to our Q&A from, I've seen there are several questions. We'll try as much as possible to handle them within the next 15 minutes. But a quick one from Kennedy. He talks about advice on profit taking even when going long, even when having how can one, because you see it's unrealized, how can one take profits even when going long?
I'm not sure I understand. I'll try and answer what I understand. I'm saying, so you've taken a long-term view, but and you still want to take profit.
Yeah.
So yeah. So I think what you don't need to sell the entire stock portfolio, but I think that's what I say, selling into strength. You could perhaps say that, you know, I've seen it rise up, I'll sell 10% of the portfolio, but retain the rest because I feel that it's probably gone up significantly. But it's a long-term stock, so I'm not going to sell it off completely. So you can take profit by trimming some of your portfolio on the top when you feel that it's gone significantly above its fundamental value. And that could be anywhere between 10, 20, 30% of the portfolio. But if it's a long-term stock, then you still need to retain it because you're looking long-term. I hope I've answered that question.
Yeah, I believe you have. Another one from Kevin. You partly answered this one about avenues where one can get information, relevant sources. You talked about the brokers' research reports. Are there any other avenues to get this information? And if someone is new in trading, what is the best way of analyzing the suitable stocks?
Okay. All right. I think there are, for me, the research reports from the brokers and the reports that they produce on a constant basis is where, I mean, you also get statistics from the Nairobi Securities Exchange and the CMA, but I think the broker reports would be perhaps your first stop to get. But the key things, the first stop, the simpler ways to analyze stocks is to compare it. You know, sometimes people say that, I often hear people say, oh, Kenya Power is a good stock because it's only 1 shilling. You mean I can just buy it for 1 shilling? And then that, I don't know, BAT is not a good stock because 1 share, you have to pay up to 500 shillings for only 1 share. Really, you need to bring it down to a relative valuation and therefore compare, say, what you would say the book value per share. So you are saying the BAT has assets worth this much and has shares worth this much. If you divide and find out these assets in terms of how many assets you get or what's the value of assets per share, which is what people call to the price to book, then you begin to get a comparative analysis rather than just saying that, just looking at the price in a simple way. So now that way you can then compare Kenya Power with BAT, despite the fact that the two prices are way ahead of each other. So the key things is to look at price to book, which is the assets divided by the number of shares that have been issued, the price earnings, which is the price divided by the profitability that the company is making. Sorry, the profitability of the company, the price divided by the earnings per share, or the profitability that the company is making divided by the number of shares that are there. You can also look at the dividend yield. So the dividend that they're paying per compared to the, so if a share is priced at 10 shillings and it's paying 1 shilling, it's at a dividend yield of 10%. So that then you can compare now. It gives you an opportunity to be able to compare different shares from different industries, but also shares in the same industry. And therefore, so if you come across, you can identify then mispricings. You can say, for example, why is NIC Bank and NCBA Bank price to book at 0.5, while Equity Bank's price to book is 1 is 1:1. So you then say, why the difference? Is it a mispricing, or is it that the company has better growth prospects? Because it could be that the market has said this company has better growth prospects and therefore is going to value it higher. That's the starting point. Just look at the relative valuation so that you are able to identify opportunities for mispricings in the stocks.
Okay, great answer. From Dennis Munene, what is the best way to hedge our investments to minimize risk?
Okay, that's a good question. The simplest way is to diversify. So if you have investments, make sure that you have at least a 5 or 6 instead of putting it all in one stock, but also diversify across industries. The challenge we have in Kenya is that Safaricom and the banks dominate our market. So you need to diversify between different industries so that if the banking industry, for example, goes through a crisis, then you're not necessarily affected. So one way of diversifying, of hedging, the simplest way is to provide diversification, but also diversify your portfolio in terms of your asset allocation. So if you put a little bit in stocks, a little bit in bonds, a little bit in the money market to provide for whatever, that's the basic and simplest way to hedge. The other hedging mechanisms would be to use derivatives or to use stock lending and borrowing. They're a lot more complicated and there's a price to it. And they might not necessarily work in your favor. But if your objective is correct from the beginning, in terms of you got into the right investment, you had your objective set, then I would recommend that the best way to manage that risk rather than hedging is to mainly to diversify and to find the assets that give you your expected returns.
Okay, great. Alexander Maina is saying he has saved 10,000 shillings. Which options are best for him? He's asking for opinion. Is it stocks, money market? He's even asked whether crypto could be a consideration.
All right. I wish he had told me his age. That would also help me advise him. But I would want to assume that he's young. So if you're young, then you need to take higher risk. I particularly not very keen on cryptocurrency. Not necessarily that it's a bad investment, but as they say, you don't invest in anything that you don't understand. While I understand the blockchain technology and I understand why crypto is a good thing, it becomes difficult for me as an investor to predict the price movement. What influences the price to move up or down? If you ask me why the dollar is moving up or down, I will tell you it's moving up or down because of what they call purchasing power parity or interest rate parity. That means that the interest rates in Kenya are higher than those ones in the US, so money is flowing one form or the other. I have not found the way to analyze crypto to be able to predict which way it's going to go and why it is rising the way it is rising. because of that, I cannot advise on that. But if you're assuming you're young, I would advise that money in high risk assets, stock market, well researched stock market shares, or an equity fund. But be patient. Don't put it there expecting that the next time your girlfriend calls you for a date, you could pull out something from there to be able to finance the fare. So take the 10,000, be patient. They say ideally 3 to 5 years is the horizon that you should look for in the stock market. And I always say, if you're committed to the stock market, stick to the stock market. Reduce and increase, but stick with it over time. Don't get in and out. So that would probably be my recommendation.
Okay, great answer there. From Kevin, any suggestions on how to invest in the stock markets of other African countries apart from Kenya, and can AIB help with this? Okay, yes. So right now it's a bit of a challenge. We do have a partner in Uganda and Tanzania, so we can be able to facilitate purchases in Uganda and Tanzania, and we are also have a partner in Ghana. We are creating a partnership with a brokerage in Egypt, which will also give access to the Egyptian market, and also so that those are some of the opportunities that we believe will be coming up. But also just to mention that there is an initiative that is being sponsored by the IMF to integrate the African stock markets, which will hopefully be able to allow investors from any country to buy shares right across, and to create some level of to allow investors to buy shares for different markets. So that we are looking forward to. It's an initiative that's the African Association of Stockbrokers has been in support on, and we hope that will come through in due course. Okay, great. Sarah is asking, please explain more. You talked about this on the 9 months window for stock trading. Does it mean that if I buy a stock and it continues to decline, when it has not returned to the price I bought it at within 9 months, should I consider it as a loss? I think you completely misunderstood. What I was saying is that if you look at a 10-year period and you look at the average return of the stock market, you will find that maybe the average return of the stock market was, say, 15% or 20%. But out of that 20%, you will find that 10% came from a 9-month period. Now, if you are not in the stock market during those 9 months, then your whole 10 years, then you look at your return on the stock market, you will find that you will then begin to say even investing in bank deposits or treasury bills is better than the stock market. The reason I'm saying that is that when you're in the stock market, commit to the stock market. Be in it for the long haul. Don't get in and out, because you could get in, get out, miss out on those 9 months, and then come back. And I've seen that happen. I used to manage a portfolio for a client, and in 2000, the stock market went down. I think the NSE 20 was below 1,000, and the client told me to sell all their shares. So it was a very difficult decision. I advised against it, but we eventually sold all the shares, because what the client says is what you have to do. A few months later, the stock market started rising. Now, the client was embarrassed to accept that he made a mistake to sell the shares then, and therefore we kept, eventually I suggested, do you think we should go back to the stock market? And the client was like, yes, please go back. But
you got to avoid that kind of behavior where you get in, get out. You've got to commit for the long haul and be in the stock market even when it's down. And that's why I say you could miss out on the 9 months that will make all the difference to your portfolio, because they say that out of a 10-year period, almost half of it. Okay, how long is long? So ideally, they say if you invest in the stock market, you've got to look 3 to 5 years, but it all depends on your objective. Really, what should be driving you is why am I investing? And that's where perhaps we lose focus. If you want so if your objective is long term, and you're looking to save maybe to buy a house, you got to look at the time horizon. If you're saving even longer, the better, because then you have the opportunity to make greater return. And we did a comparison one time with a friend of mine who said, the time when the plots were giving very good returns and people are doubling their whatever. I told him, you take an example of a plot bought in 2000 compared to Equity Bank. I think was it Equity? I'm not sure which share we used. But I said, and compared it with a share in the stock market, and the stock market actually, the share actually showed a slightly higher return than the investment in the plot over a 15-year period. The time horizon was, I think, about a 15-year period. But also the return was significantly big difference. If you ever did a backtracking and looked at the price of equity, Safaricom, KCB, for those who have invested 10 to 15 years, you would be shocked at the level of returns that you're looking at. We are talking about all-in returns of close to 300, 400%. So the stock market has good opportunities, but for those who are patient and those who have a long-term view.
Okay, since you've now mentioned about real estate, there's someone who just wants a simpler explanation about investing in the real estate investment trusts, since it's part of the NSE.
Okay, so real estate investment trust is just a way of investing in property indirectly. We've got two types of investment trusts. We've got an income investment trust, which really invests in rental property, and by law have to distribute 80% of what they get, they have to give out in dividend. So it's more of an income play, and we have the Fahari REIT. So it's an indirect way of investing into property, shillings, and therefore the mathematics didn't quite work out. But having said that, real estate investment trusts, if done well, are good. They have a good investment. The other are development REITs, which then you are investing in a company that's doing a development. It's much longer term, because the investment in developments is longer term, and the return that you will come once the development is complete and the unit sold. So it's a much longer play. It's a unique situation. The development trusts don't exist. I think Kenya is probably the first place where these have developed, and we've had Acorn doing their first development trust in this market, which funds university accommodation. So it's a new thing that's coming to the market, hasn't quite picked up, but I think it creates a lot of opportunities for indirect investment in property, but gives you a distinct advantage. One of the challenges of investing in property, and most of you will agree with me on this, is properties are illiquid. If you decided to sell your plot, it'll take you at least a year, 6 months to find a buyer, and another 6 months to complete the transaction, between the lawyers and the land registry and all that. It'll take you at least a year to complete and receive money in your whatever. Even if it was a rental property, it takes quite a long time to do that. But once it's in an investment trust, then it becomes instantly sellable on the stock market. So that's the whole idea of creating real estate investment trusts.
Okay, it seems that we have overshoot time. There's so many questions that needed to be answered. And maybe now you'll need to organize another session for all these Q&As. Nailante, you can organize another session. So unfortunately, we'll have to close there, and we can plan another one to answer all these many questions, but maybe you can give your closing remarks, Paul. What are some, do you have the biggest mistake you have ever made when you're investing in the market? And what was your greatest lesson, just to wrap it up?
Okay. The biggest mistake I have made is falling in love with a share. The stock market is not a place for romance. So sometimes when you've invested the shares, you've talked to the management and you're feeling like these guys know what they're doing. And maybe it has made you money in the past and you want it to make you money again the same way it made you in the past. And you stick to a share, even when the fundamentals of that share keep telling you that, you know, these markets, whatever. And it even begins to cloud your judgment, that you're no longer looking at it objectively because you're in love. And you know what happens when you're in love. So that's perhaps, I wouldn't tell you which share it was, but that's a story for another day. But that's one I will warn you that we always need to be aware of, that the stock market is a place to invest, and that and no matter how good a return you get from one share, you always need to be able to look at it objectively. And that's why it's always important to listen to other analysts and to look to what other people are saying, because you want to replicate what has happened in the past, and that's not always the case.
Okay, thank you for that, Paul. I truly enjoyed this discussion. I'm sure even all our viewers have enjoyed the very insightful discussion. Even Sarah Nyawera is acknowledging and saying it was a wonderful session and a lot of knowledge has been acquired. Maybe you can organize as AIB to answer all these questions, since I'm sure you'll have the records of those who have asked, and personally just respond, maybe if you can, to some of the questions that have been raised via email. So thank you all for staying tuned to this very informative session. It has been quite engaging, and I hope you have all acquired the relevant knowledge to begin investing in the stock market. So thank you all. I have been your moderator, Diana Morioki Maina, the CEO of ISIFA. Paul, once again, thank you. And I'd like to hand over back to Nailante. Yeah.
Wow, thank you. Thank you everyone for your attendance, and then a special thank you to our panelists, FA Diana and FA Paul, for a very engaging and insightful session. We can see in the chat that people really gained and learned a lot. We are so privileged to have had you with us tonight. We also want to thank Abojani Investment and AIB-AXYS Africa for hosting this webinar during Financial Literacy Month. And yes, that marks the end of our session tonight. Thank you all. You may leave.